Excellent.
Mhm.
Well, I would like to welcome our audience, welcome our loyal attendees who kind of come and attend to kind of most of our webinars, and new people who are joining today. I was just thinking, just prior to joining, thinking, oh my gosh, I just recently kind of greeted people that people were coming back from summer holidays, and it's great. We're in a full swing to get back to work. And now I'm greeting people, it will be last time we see our audience before Christmas and New Year. I was actually like horrified thinking, oh my gosh, this year has gone now almost. We only got about another really maximum 2 weeks, of this year, and everyone will start kind of heading for Christmas holiday. So taking this opportunity to kind of greet everyone with upcoming holidays. I hope that everyone had a great and successful year. I know that it's been stressful for most people, so I think people will be also kind of looking forward to ushering this year, and with the hope that next year will be a little bit more stable. But so now, for those who don't know us, we are QPQ International. We are deal advisory and a platform focused on helping green energy project developers secure equity or debt finance. We are priding ourselves in, if that's correct word to say it, to actually in our ability to structure sophisticated funding solutions. Hence, topic today, because most of the projects that we're working with are projects in development, different development phases. So development finance has proven to be the hardest part of the equation. When we start moving to kind of construction finance, is much more straightforward. But development finance is a quite difficult task. Hence, we've got our expert today, Magnus, whom I will introduce shortly, with a wonderful topic that he covers today. So, yes, so in the nutshell, we are helping green energy project developers with funding. We are a team of 32 people, growing quite organically and dynamically. So if you have projects in renewable energy, waste to energy, hydrogen production, and energy storage, do share it with us. And we will, I'm quite confident that we will be able to add value and bring you some sophisticated, great funding solution. We always strive to structure and look for kind of optimal cost of capital solutions, and we have our team kind of geographically focused. So our main focus has been Europe, US, and Canada, and then of course then there are selected countries because we do have kind of presence pretty much all over the world, with most of the countries that participate in green energy transition, with the focus, as I said, in Europe, US, and Canada. And Magnus is in Europe, and he has over 30 years experience in project finance, with great emphasis on working in very senior executive positions for various kind of development finance institutions, with a focus on Nordic countries. Magnus is one of our advisors, and I'm very, very proud to have such accomplished professional in our team. I'm also excited about this topic, as I said, that it's not really well covered. And Magnus, as I said, been kind of part of development finance for last 30 years. So he has seen evolution, how it's been kind of evolving and developing with its kind of challenges. And today, the presentation will cover exactly that, basically overview of development finance with its challenges, and now, of course, also will an evolution. And then Magnus will also discuss, future outlook and what can be expected. Right, Magnus? So with all the excitement, thank you so much for being here today, Magnus. I'm very excited having you talking to our audience. Many of those who are in the audience today probably already kind of met you, maybe, through interactions with projects that you're working. You already have got quite a strong portfolio with QPQ. So now we'd love to usher you on stage. We're already on stage. Give you a microphone and yes.
Let me jump in and just add a little bit to what Oksana said. So we as a deal advisory, investment advisory, focus on project finance. We bring strategic equity partners. We help developers to raise debt, and recently we also, found some sources of development capital. But we also help developers to sell their projects. So, whatever funding needs you have, please, reach out to us. I will be sharing in the chat. I'll be sharing Magnus's presentation and also a few useful links where you can submit your projects, where you can learn more about our referral program. It's not necessarily you have to be a developer if you have access to projects, or you have someone who might need funding or want to sell their project in the renewable energy space, because that's the only thing that we do at the moment for the past 5-6 years at least. So then please, I'll put my email address and also the link where you can submit the project and some, preliminary information for us to at least look at it and tell you if this is something we can help you with. So now, the way we're gonna run today's webinar is, for those who are new, it's basically first will be Magnus's presentation, and then for the last 15-20 minutes, we're gonna have a Q&A session. So there is in Zoom, there is a separate option, it's not, chat doesn't work for Q&A for questions. So there is a Q&A button where you can click and write your question, and in the end we will kind of accumulate them, and in the end, depending on how much time we have, we will go through as many as possible. So I will be uploading all the materials in the chat now and also in the end one more time for those who join a bit late. And we will be circulating the recording of this, for those who were not able to make it. So that's all from my side, Magnus. It's great to have you. So please, if you want to introduce yourself and the topic of today's webinar would be great once again.
Thank you, Oksana. Thank you, Vlad. And thank all of you for joining today. Good afternoon, good morning, good evening, wherever you are in the world. It's a real pleasure to have you in this seminar. I've joined QPQ rather recently this year, and it's a real pleasure to work with the team, and it's also a great pleasure to do this presentation today. My background, as Oksana mentioned, is from development finance institutions, primarily the IFIs, international finance institutions, but also Nordic finance institutions, the United Nations as well. And I've worked also with the Gates Foundation on innovative finance, but primarily really on large scale or middle-sized investments in infrastructure and energy in low-income and middle-income countries. Let me now share my screen. So somebody needs to put on, I think, the sharing option for me.
Yep, that's done. So you should be able to do it now. And by the way, I'm on the background. If you need anything, just talk to me. I can hear you.
Yeah. So let's see. Is it now sharing?
Yep, I can see it properly. It's a full screen. Yep.
Very, very good. Okay. So I will speak about development finance, but I would like to, from the outset, to be very specific about that this is not necessarily what we call DevEx. It could be, but it's really the larger picture of financing for development. So middle income, low income markets, high risk, difficult environments, where the world for at least 40, 50 years now has tried to make headway to de-risk market, to allow investments that are conducive to development. In the last 15 years or so, almost now, not quite yet, but we have the 2030 agenda. Before then, we had other development goals, but all of them have been working towards poverty reduction and trying to help countries that are middle to low income in nature to find pathways to development. So this is the financing of that I'm talking about. But then will be very specific also about the green energy dimension of this. But maybe just first, since this really is about green energy, let me jump into kind of the overview of the current green energy finance. And this gives you here now a bit of a just overview of what I will go through today. I may have to skip some dimensions because of time, but I will start with the overview of the current green energy finance landscape, because I think it's important to understand where we are today before then going back in history and see how we got here. And it's not a great story in some ways because we're far off from where we want to be, maybe to say that from the outset. Now, in 2022, global investments in green energy transition technologies reached a record of $1.3 trillion. And this includes renewable energy, energy efficiency, electrified transport, energy storage, hydrogen, and so on. However, this amount is far from enough from what we need. And to meet climate goals, annual investments should be around 5 trillion by 2030, which has again been confirmed at the latest COP. And this is hence 4 times more than what we've seen in the past few years. And why is that? Well, factors such as geopolitical instability, economic downturns are adding complexity. We've seen violent conflict. We've seen a lot of humanitarian needs. So a lot of the money that might have gone to the kind of more long-term development space in general, including green energy, has gone somewhere else. And the power sector has made significant progress, of course, in renewable energy, with 83% of global capacity additions in 2022 alone being renewables. And this is data from IRENA, the International Renewable Energy Agency. And installed renewable capacity reached 40% globally, driven by a record 295 gigawatt added last year. And last year, in this case, is around 2022-23. However, growth remains concentrated in a few places: China, in the EU, in the US, accounting for 75% of additions. Solar PV has been the standout, growing 26 times since 2010, reaching over 1,000 gigawatt by 22, and of course now even more. And thanks to cost reductions and strong policy support. Wind power, and by the way, cost and policy support, and this is important because what's been supported by a lot of governments in these markets has not been the case in a lot of the middle income and low income countries. They have been more or less to themselves and whatever the private sector can do with some public money, which I will get back to. Now, wind power also grew significantly. Hydropower, of course, remains the largest renewable source. And also bioenergy and geothermal are growing rapidly. Also, off-grid renewables are expanding by 11% in the last few years per year, and even more so. I will get back to that because it's a very important dimension of this presentation. Now, again, so IRENA has provided this information here, this data. This is a slide that shows you what IRENA thinks is currently being planned in the world on investments in green energy. So PES, that's the planned energy supply scenario, sorry. But then you also have to the right of that a scenario that links to the Paris Agreement. So 1.5 degrees max centigrade Celsius increase. And it shows, of course, that you need to be much, much further ahead than we are today. So this just gives you an overview how far behind we are in spite of these improvements and the still quite strong growth. Now, what's interesting is that we've seen a rebound of fossil fuel subsidies in the last few years, kind of after the COVID crisis. And it's back to basically pre-pandemic levels. But on the renewable side, we've seen, a 0.5 trillion in investments, but to meet the targets, then we need to be at the minimum of 1.6 trillion annually. Now, this shortfall is quite concerning, of course, and the issue compounded by ongoing fossil fuel subsidies makes it even more concerning. The technical potential of new renewable energy technologies far exceeds the current global electricity production. In fact, the outlook period from 2020 to 2030 and on to 2050, most capacity additions are projected to come from renewables. According to IRENA again, the assessed renewable energy capacity will expand from some 6,770 gigawatts by 2030 to 15,800 gigawatt by 2050. And renewables share in generation scales up from 28% in 20 to about 46 and 70 in 2050. But again, this is not what's going on. The current plan is just not good enough, and there's a big gap. And it's widening, in fact, every year. Now, if you look at the total global electricity generation capacity expansion, Again, you can see here that the power systems of tomorrow will need to integrate very large shares of generation from variable renewables. And this will be a considerable challenge, but it's possible to do with novel operational strategies and mechanisms, according to ARENA. However, a range of renewable sources are needed to achieve the 1.5 target, and each technology plays a key role in meeting electricity targets. For example, there's new technologies quite recently now being explored to utilize not just the tidal waves of the world, but also the large ocean streams and tides like the Gulf Stream, which would be a base energy production. So not what we usually have in renewables, but a base energy. But it all needs to be, and hopefully will be, a transformative shift. And we're in the middle of it right now. It's just not going quick enough. The bottleneck here, among a few others, is, of course, the power networks. But here the opinions are a little divided in terms of what we actually need, because also you will see quite a lot of energy savings by new types of transmission technology, but also by how we use energy. So at the G7 meeting that I attended in Torino of the energy ministers here in the spring, the Italian presidency, there was quite different opinions about this by some of the leading researchers, which I think is quite interesting, because we're so focused obviously now on the bottlenecks of transmission, and of course they're there, but maybe the future holds some surprises in terms of technology that we are not quite aware of right now. But this just shows you where we need to be and where we are. Now, in terms of to limit 1.5, again, as I mentioned, 1 trillion needs to shift annually from fossil fuels to renewable energy sources. Now, currently, we are seeing a mismatch in the investment needed and also in the investment available. And this gap must be closed, and very rapidly so. And energy investment should drive the transition while avoiding the risk of stranded assets. So again, I think here we see new technologies coming on stream, like hydrogen, like sea-based hydrogen production, that could provide some technology shifts that make this all a little difficult to predict. But certainly we're not where we should be. Again, here, this shows you the global investment by technological avenue, planned energy scenario, and the other one, then 1.5. And it just shows you again where we are projected to be and where we should be. And this is the mix, which you can see from this slide. Now, solar obviously dominates, and there's a risk that other promising technologies might be neglected, like the ones I just mentioned. And I think this is something that is currently really being placed at the center of the discussion, also at the COP in Baku, that we really need to diversify how we produce renewable energy, even though solar obviously will probably continue to be probably the main source, I would say, in my view. Now, the private sector is leading the charge here, and this brings me now into the development finance space. It contributes 75% of investments from 2013 to 2020. This is globally, not just in low-income countries. And most of these investments came from commercial financial institutions and corporations. And while equity finance has been primary form of the investment, there's been a notable shift towards debt financing, especially in mature technologies like solar, wind, where lenders can expect stable returns. And one of the most striking issues is the regional imbalance in renewable energy investments. While over 50% of the global population resides in low-income, I call them low-income or middle-income countries, they receive just 15% of the global investment in 2022. And sub-Saharan Africa, which faces significant energy access challenges, received less than 1.5% of the total renewable energy investments between 2000 and 2020. And this, of course, is a major obstacle for global energy equity as such. And of course, Africa is going to expand its population, whereas other parts of the world probably will see a contraction. So this is particularly serious. And this disparity needs urgent attention. And for example, for North America, the gap was even larger than with the EU, 57 times higher than in Africa. And this stark divide highlights the need to direct more investments to developing regions to achieve a fair and equitable energy transition. And the gap must be closed. And here, development finance does play a very, very central role, as I will show. Off-grid energy has shown some very promising growth in the past few years, whereas it was stagnant before. In 21, off-grid investments grew by 27%, totaling around $560 million. And we still need around 2.3 billion annually to achieve universal energy access with off-grid solar. And what's interesting here is to see in low-income environments that off-grid seems to be the go-to solution more and more, simply because the grid isn't there or it's not functioning. And maybe we're actually seeing a jump of technologies like we saw where fixed phone lines were not installed, but one went straight to GSM networks. Maybe something like that will happen here. Of course, there's limits to off-grid, but with new technologies coming, also transmission technologies, maybe this is what we will see. Now, public financing, and this is where I get to the development finance part, plays a pivotal role in de-risking off-grid renewable energy. And development finance institutions, that's a term for all of the kind of organizations that somehow have a public mandate or a development mandate, meaning they work in low-income, middle-income environments. They account for 79% of public investments in this space between 2010 and 21. And this just shows you how important this sector is for low-income environments. And of course, there's room for improvement, and international collaboration and the mobilization of additional public funds across borders could significantly boost energy access in underserved regions through off-grid. Now, we need to accelerate the investment, as I mentioned. And this is particularly, of course, true in low-income environments, where the energy access gap remains a major challenge. Public financing will continue to play a key role here, especially in high-risk regions. But for energy transition to succeed, we also need innovative financing models, like crowding in private finance, commercial finance, and stronger policy frameworks to support both public and private actors. Now, let me then turn to the kind of definition of development finance. So this is an overview now that I mentioned on where we are and why development finance is so crucial. And the definition, I don't have to go through the entire slide here, but it really is, it includes, both public and private flows these days. So we've moved away from the pure ODA, which was grants from donor governments, the OECD DAC countries, to also include other flows, including then grants, loans, equity guarantees, and mixes of those, which is blended finance. And so the OECD has different ways now to describe how countries contribute to the development of low-income, middle-income countries and regions. And of course, the rule is that everybody's agreed to is that 1% of GDP, GNI, should be invested in some kind of overseas development or official development assistance, which only a few countries reach today, like Luxembourg and Sweden. UK, Germany have tried. They've been close to it, and now Germany is pretty close to it, actually. UK slid back. The US is very far down on 0.15%, for example. Now, the origins, obviously, of development finance is interesting because here you can go back to the Second World War, with the establishment of the Bretton Woods institutions to rebuild the world, not just Europe, but the world. So the World Bank was founded in parallel to the United Nations. What separates the World Bank from the United Nations is that in the World Bank, you have the voting power according to your hard currency that you pay in, whereas in the UN, you have one vote per country. This makes a big difference in terms of policy and what the bank does, and then also what the UN does. So they have different roles in the community of the world today, as they did already at the start. Quite shortly thereafter, in 64, well, 20 years later, the African Development Bank was established in 59, the Inter-American Development for Latin America, and then the Asian Development Bank in 1966. And also to mention, the UN had its own development finance institution established, which is the UN Capital Development Fund, where I used to work. It never really took off, so it started playing a role more as an innovative finance, a blended finance institution, investing in microfinance and other types of ways to de-risk very difficult environments for the least developed countries. Now, some other key milestones here to mention, I think, is in 1958, the European Investment Bank was set up, which is today the biggest development bank. Obviously, it focuses a lot on Europe, but not just. You also have the European Bank for Reconstruction and Development in 91, which focuses basically on Eastern Europe, but now further east also into Asia. And in the Nordics, you had the Nordic Investment Bank and other institutions set up in 76 that became quite important for the Baltic region after those countries became independent in 91. And then you also have, the national development finance institutions like FinFund, Swedfund, and others that are mentioned here that have similar roles, primarily though private sector investments, so typically private sector. And a lot of these now have integrated the Paris Agreement into their strategies. So green climate finance is very, very high on the agenda. This just gives you an overview a little bit, and I'm not going to go through it, you can look at it later, of the different sizes of these banks and what they actually do. And you can see most of the international development finance institutions, meaning the World Bank Group and the regional development banks, are quite large. Of course, not in the bigger picture of things, but in terms of in relation to other development organizations. They all offer private sector windows, equity, debt, and they offer guarantees. They offer grant windows or concessional financing, and they've more and more been involved in hosting different types of funding mechanisms like outcome-based aid mechanisms and other vertical funds. There are several that the World Bank hosts where also private sector organizations actually sometimes can have a seat at the table, such as the Gates Foundation and so on. But the biggest source of grant money in the world today is the European Commission, but also then IDA, the International Development Association, which is the World Bank's concessional window, $28 billion in annual disbursements, both grants and concessional loans. Here are some of the foundations of green energy finance. This is important historically, of course. You can see the UNFCCC in 92. It was set up. The World Bank got involved quite early as well. And then, of course, you had the first COP in 95 and the latest one just now in Baku, as you know. The Kyoto Protocol was very important. Also, the Financing for Development Summit was super important in 2002. Which was then, it was repeated a few times afterwards in Doha was the latest one, which really sets the framework for all of development finance, financing for development. It's a UN conference, but it really is the overarching kind of framework for development finance. Then the World Bank launched the Carbon Finance Unit, also in the 2000s, and the regional development banks followed with their green energy and related initiatives. And then throughout the 2010s, you can see the Paris Agreement coming along. The Green Climate Fund was set up again as a vertical fund under the World Bank. The Addis Ababa Action Agenda, very important in 2015, followed by Doha later on. And you could see the bank the World Bank involved in solar energy here. The COP mechanisms, again, that they're putting the framework for negotiating the government dimensions, but also lately private sector recommendations, and then the FFD summits. Now, as I mentioned, these organizations, the development finance organizations, all have central roles to implement what the decisions are taken at these conferences and summits. And so do actually the national development finance institutions, again, publicly funded. Here you can see a little bit the portion of development finance funding in the forms of grants, low-cost debt. I think this is quite interesting to look at. Of course, what you can see is that the main sources of public finance in 2020 comes from state-owned financial institutions, such as the World Bank and the National Development Finance Institutions. Multilateral DFIs, such as the World Bank, provided 9% of public finance in line with their past annual commitments. And accounted for about half of international flows from the public sector. The commitments from the bilateral DFIs in 2020 fell 70% compared to 2019. And this is super interesting, and I get back to that. There's something wrong in the system. The strategies are not following what the realities say on the ground in terms of risks and opportunities, and they're falling behind in terms of doing what they're supposed to do, de-risking markets. And this is something I'll get back to that, but that's one of the key messages here. And again, just 3% of total renewable energy investments in 2020. And going forward, these multilateral and national DFIs, they need to direct more funds at better terms towards larger scale, but also missing middle, what I call them, investments in green finance. And in 2020, financing from bilateral and multilateral DFIs was provided mainly through debt financing at market rates. And this is just not good enough. And Al Gore made this point very clearly at the COP. And this means that repayments are required with interest rates charged at market value. So you typically have a successful green energy company working in an environment that is high risk in a low-income country in Africa, for example, facing really only development finance institutions because the private sector has more or less moved away from these organizations and these projects in the past few years, which is very alarming. So the only one they have to go to very often, not always, are these DFIs, and then very often they charge in the tens of percent, so 10%, 11% interest rates, hard currency loans, and the tenor not long enough, and they expect IRRs above 20. And this is in markets where there is no public finance to subsidize green energy that we've had in OECD countries, and where succeeding is super hard because of all the risks that we know in these markets. So something is not working. Now, despite Africa's vast potential, again, it's just 2% of the 2.8 trillion spent on renewables globally between 2022. And this is, of course, not even close to good enough. And in this tiny percentage, South Africa, Morocco, Egypt, and Kenya stood for 3/4 of that amount. So you can see that sub-Saharan Africa is almost completely missing from the picture. And here, of course, this is just not acceptable, and something needs to change in the policies of the development finance organizations. Now, these disparities, need to be addressed. And between 2013 and 2020, the private sector did play a dominant role in the energy sector, but they largely bypassed the poorest countries. So focusing on low-risk advanced economies. And this leaves the most vulnerable populations underserved and struggling to access basic energy. Even more so, once they do, they pay more for it because the development finance institutions don't have the capacity or the policies to play the role that they should. So ironically, people with the least resources pay the most for energy. Now, governments are stepping in to de-risk projects and attract private investments. I mean, governments in this case, in low-income countries themselves. Of course, that's a very good step forward, but they are very, very constrained in terms of their fiscal space. So when they do, they typically divert funding from some of the social sectors where the funding is urgently needed. So again, this just kind of worsens the fiscal constraints. And here you've also seen a debt crisis, of course, that moves in parallel to this whole timeline I've mentioned. And debt relief remains a very difficult and crucial issue. And we're talking about hard currency debt here. So by addressing market failures and aligning private incentives to public goals, we can create financing mechanisms that serve both investors and underserved communities. And most public investments are made from national sources with relatively little international collaboration. Bilateral and multilateral DFIs together provided less than 3% of global investment in 2020. In addition, more and more financing comes from bilateral and multilateral DFIs in the forms of, as I said, debt financing at market rates. And this requires repayment with interest rates charged at market values. Grants and concessional loans amounted to just 1% of total renewable energy finance. And very often not in a way that actually promoted bankable or de-risking bankable environments. So they were paid out very often as pure grants. And since the interest rates are the same, the only difference that DFI's financing provides very often is to make financing available in the first place, but at very high costs for users. So this means that the lowest, again, income people pay the most. Now, the public funding for renewable finance and climate finance more broadly has struggled. And particularly over the past 3 years, we're seeing that there's a search going on. What is next? How can we find better models here? How can we prove it works? Because if we can't prove it works, there will be no more or additional funding coming from ODA budgets, from grant budgets, from donors. And this is what we're facing today. The money that comes today is also directed into other needs, as I mentioned, food shortages, disruptions through violent conflict, and other types of humanitarian finance requirements. So we're really looking at a really difficult situation, in my view, in how the world now moves forward on green energy in low-income environments. And as I mentioned, this slide shows you a little bit the annual commitments and off-grid renewables by financing instruments. So you can, I'm not going to go through it because it's a lot, but you can see here again that the DFIs do play a role. But when they do, very often, it is not in the way that really promotes the de-risking that is needed. And maybe to jump a little bit forward, because I think we're running a little bit out of time, I think the problem here is that we're really seeing this slide I'm not going to go through, but it shows you the picture of the entire kind of system that we're working with all the institutions, the policy environments, the international South-South cooperation as well, and so on. So this is something you could look at. It's a great slide from Irina. Here are some of the investment portfolios that these organizations have. Again, I'm not going to go through it, but I think it's quite useful to have it collected. These are some of the development finance examples that are more funds, vertical funds that exist, that can be accessed. And here are some more grant-oriented de-risking organizations that can be also accessed. The European Commission is not mentioned, but that's of course a major source, but within certain also limits, because it has to be linked somehow to the EU. Here are some of the philanthropic foundations that have green energy in their strategies. Very often they are quite innovative in how they work. They go in and de-risk quite innovatively and crowd in private capital, but their financing is rather limited. Now, microfinance, I wanted to mention just very quickly. Microfinance has been important in the whole process to kind of proving that poor environments are bankable. And I want to bring it up here because this is really what led to the hope in development finance in also the impact industry that I will mention in my next slide. Microfinance still is a huge thing. It's now commercially more or less viable. Poor people do pay back. It doesn't mean it creates more entrepreneurs than in other environments, in OECD countries' environments. That was, I think, the problem, that there was over-promising and under-delivering on microfinance. But it does mean that microfinance has proven that under certain conditions, poor people are bankable and they do pay back. And this led the way then to a very promising development to go one step up into the missing middle, because still today, in corporate finance, but also in project finance, this is where the biggest gap exists, both in terms of the pipeline, not that there are no needs, but there's too few project development capacities in low-income environments that can develop a project into a bankable project, so the kind of work QPQ does. But there's also too few companies that manage to move on from Series C or A, B, C, kind of, they get stuck at C, because in this space, the DFIs become very risk-averse, the development finance institutions. And I'm supporting a number of these companies in trying to find a way to navigate this space. And it's very, very, I think, odd and strange that you have several very, very well-performing companies in very difficult environments that just cannot manage to raise their C series and grow, and have to start firing people in spite of good growth in their business, good demand, and so on. And so this is, I think, one of the major bottlenecks, both in corporate and in project finance today. I launched a program at the UN Capital Development Fund to try to circumnavigate these problems, called the Local Finance Initiative, where we basically took around $15 million from the Swedish government and invested it in de-risking instruments in mainly project finance projects in low-income environments. So both on the project development side, so DevEx, but also on the de-risking side, and carrying companies or projects in this case over the valleys of death very flexibly, without saying you can only go in this country, in this region, this sector, or only this junior debt or this senior debt. So we were super flexible. Of course, that's not a big amount, but we showed it can be done, just like microfinance showed it can be done. And here's that initiative I just mentioned. Now, innovative finance is, and I'm coming to slowly to the end here. Innovative finance then again came out of this promise that the poor can be banked, and we've seen a great flow of financial engineering come on stream in the past few years. I was in charge of innovative finance at the Gates Foundation for a couple of years here in Europe. And I was involved in this. And as a finance person, it was super interesting, of course, to look how you could design first loss guarantees, partial risk guarantees, how you can, front load aid by using development impact bonds that then would be, so you basically sell bonds to the market, and then the market is reimbursed by development aid after, for example, 5 years based on certain targets that then a third party would validate. Things like that have been done, some of them very successfully, like the IFIM at Gavi, the Vaccines Alliance. There's also semi-equity instruments like performance-based grants that are triggered based on performance. There's, of course, all the kind of versions of longer tenors, lower interest rate, junior debt. There's local currency lending. But that one, I think, is probably the biggest elephant in the room, because currency risk in most instruments that we created was just too hard to deal with, too hard to mitigate. A lot of the other risks can be dealt with. But this is financial engineering. If you don't have projects coming your way because the development sector, the project development sector is not well enough established, this doesn't matter. And this has been a little bit the problem. So we focused a lot on financial engineering, not enough on pipeline. This has changed in the past few years. But at the same time, and again, coming to my main point here, the impact investing industry, which is private funds that have an impact, such as responsibility or bamboo finance or others, they came on stream with commercial investors into these funds promising impact delivery, so SDG-related delivery, for example. And it looked really good in the beginning because they sent professional people out from the banking industry, not development workers, and surprise, surprise, they found golden eggs in low-income markets that nobody had seen because nobody really had been looking for them. And they put them into their funds, and these funds took off, right? They did really well for a quite short period of time. Then these golden eggs dried up, and they were in the same boat as everyone else. Now they had overpromised, they were not delivering on their impact and not on their returns either. So today, I would dare to say that the impact industry is in a bit of a crisis because it's not really able to perform what it was set out to do. So something is not working here, as you can notice from my now coming to the conclusions here. And the green energy financing space in low-income environments, it's just not adjusted to market realities. If you have a company that's been working successfully and growing steadily, for example, on green energy leasing to the C&I, the commercial and industry sector, which is the missing middle space again, which is probably the most important, and they cannot go beyond Series B because nobody wants to give them Series C for no good reasons, rather than, but, and this is not a good reason, that's why I mention it, that their IRR doesn't seem to be able to continue above 20%. That is just not an environment within which we can promote green energy growth. We cannot have development finance targeting 20 plus IRRs, offering 10% plus interest rates in too short tenors in hard currency, expecting companies to be able to function and grow in that environment. And that's exactly what's happening today. In fact, I would argue, and there's a few emerging now hopeful signs that this is kind of starting to be realized, which is, it's strange in a way, but I think people have been blinded by these over-promising under-delivery kind of last decade almost. And if a company has a -3 profitability, so a small loss in a very difficult environment, let's say a least developed country environment, so it's working in a bankable way, right? It's just there's just a minor loss. Why would nobody want to come in and cover that minor loss with development money? And there's no answer to that, right? Because in the boards of these organizations, that's just not accepted. What they expect is high returns. Otherwise, it's development aid. So we're still stuck in this situation that we were in a way when it all started 20 years ago. And in spite of all the financial innovations and the de-risking structures, we just haven't really been able to get to where we need to be. And I think that's where we need to focus these days. Rather than cutting aid, we need to increase aid by proving it works in realistic scenarios, not unrealistic scenarios, which is what we're seeing today. Now, giving away money is never the solution, except maybe for some of the social sectors or humanitarian aid, because obviously that does not generate growth. It does not generate the enabling environment for bankable projects that are so keenly needed. We need proof of concept. We need deepening of these markets. We need to allow the capital markets also to function beyond some of the commodities you see in sub-Saharan Africa, for example. We need to allow the diaspora of these countries to invest into these markets beyond the very, very narrow opportunities on the stock exchanges, for example. For example, by opening up the loan portfolios of development finance institutions like IFC, for example, so that you can actually invest into them, which is what the commercial bank does. So somewhere there is a misconception here, I think, in terms of risk and what concessional finance can and should be used for. I think we haven't been able to prove how it works or why it works. And therefore, there's less agreement politically to put in more money. And this needs to change. We need to turn around into a positive cycle rather than a negative cycle. And I think our work at QPQ in this sense is super interesting because we help the project developers to bring projects to the market that are bankable. And with the support of correct de-risking instruments, we could also do it even more so in low-income environments. So thank you very much. I stop here and open up for questions.
Thank you, Magnus. Very, very interesting and I think very relevant presentation and content. I hope our audience, and I'm pretty sure they enjoyed it. There are some questions that we still have time to answer. So let me read it out for you. So, they're quite long and kind of split into comments and questions, and they kind of country specific. So it would be good to hear your input on those specific countries. First one is for Ukraine. So in Ukraine, both bankers and investors face challenges due to the lack of reliable bilateral private off-takers for PPAs, power purchase agreements, while offtake agreements with the state have proven deficient. What de-risking strategies can be employed to address these challenges? For example, such as the creation of an insurance fund to back up these agreements.
Yeah.
Would this work in your opinion? And additionally, what successful solutions or models from other regions or countries could be adapted to the Ukrainian context to mitigate these risks and encourage investment?
Yeah. Thank you. Well, obviously, PPAs is always on everybody's lips when you are talking about how a data room looks, for example. Do we have the PPA? Some markets one doesn't because there's competitive instruments. But in low-income environments, if you don't have a PPA, you will not be able to go into a financing situation, investing situation. So what we've seen lately in, for example, the Southern African market is that the energy purchasers have been organized. The power purchasing organizations have been organized by some NGOs, actually, non-government organizations, into pools, where if one defaults, the pool picks up the agreement, right? And this is a very promising, I think, way forward. It's very innovative. I don't think it exists anywhere else. And this is not yet launched, I think, but it's close to be launched. And I think that could make a major difference. Of course, insurance products are always an option as well, right? In the Ukrainian context, there could be collaborations like pooling as well that one could look at. But of course, insurance products, I think, would be the way to go. Potentially guarantees that could be structured that way as well. But of course, if there is no solid PPA in place, or if it fails, right, which is very often the case in sub-Saharan Africa, then everything else fails, right? I mean, you're basically running into the red very quickly with your project.
Yeah. Great, thank you. So another one, how is actual and future situation according risk and warranty requirements for renewable energy projects in Africa, for example, Nigeria, and also in Latam, Uruguay, Argentina, Brazil?
Well, as I mentioned, I think the private sector has a very, very important role to play. And by that, I mean particularly the domestic private sector here. Domestic banks need to be allowed to go downstream. When I say allowed, it means they need to be, if they don't have the capacity, they need to be provided with the due diligence capacity to assess smaller scale projects. In many markets, low income, middle income markets today, they're just not doing that because there's no track record. And the reason there's no track record is because there's very little pipeline very often. So here, the development finance institutions are not playing that role as they should. And Al Gore is completely right. They're definitely providing de-risking for large-scale projects. In fact, they might be the only game in town for large-scale projects. So a mistake that is often made in low-income markets is, for good reasons, trying to approach local banks and other solutions to financing your project before you go to IFC or the bank, because when you do that, you are in a much longer time frame and much more costly potentially before you will get your financing because of the requirements. So it's natural to go the other way, but in fact, quite often it would have been better to go straight to IFC and take that hit, and that's just not good. It's not the way it should be, and this is my point here, right? So domestic banks need to be allowed to get their hands and feet dirty. There needs to be ways for them to get trained on due diligence. They need to have de-risking instruments that are realistic. And when that happens, at the same time, we need to work on the project development side. And the project development side is super difficult because it requires a lot of capacity and technical skills to develop green energy projects. And if you don't have those engineers, or if they're too expensive, or they're being bought up, so to speak, into the international organizations in the most difficult markets, then there's no pipeline. So I think it's an ecosystem where the financing is adjusted to the market realities, the capacity is being provided, and the pipeline is being built. You need all of that. And I think that's being realized. Financial engineering is never going to be enough.
Great. And is there any better options for debt or equity? Kind of what would be the other institutions perhaps that you could suggest? But I don't really understand how we can, project finance consists of debt and equity. I know there are some other kind of alternatives like grants and perhaps what suggestions you have on this.
Well, I mean, first loss and junior, equity debt can be structured, right? And some of these foundations I mentioned have been quite prominent in piloting some of these instruments. They're not big enough to make a big dent, but they can show how it can be done. And then it can be replicated and scaled up by local banks. And I think that's been super important for some of the financial engineering we've seen. The grant instrument is only a last resort and only in low income, the least income environments, least developed countries. But it can also be a way to, it's called basically a performance-based grant that is staged based on the installments, just like an equity could be, or sorry, debt could be rather. Performance, generates these installments, but it's not equity in the traditional sense of the term, right? There's very little money for that, but in most development organizations like UNDP, most other UN agencies are not allowed to do that because they can't do grants above a certain limit, which is also one of the constraints that it's difficult to understand. So they can hire consultants, they can pay for salaries, they can pay for a few goods and services, but they cannot provide $2 million unearmarked grant, for example, that could act as a quasi, so to speak, equity to a well-performing company, for example, or a project very easily. Now, IDA, of course, to the low-income countries can provide grants, and also IFC has now concessional loans that they're providing into projects. IFC has been quite I think, well set up in terms of taking equity, whereas EBRD, for example, has a much less exposure to equity, which is hard to understand. So I think IFC has been leading the way, at least in its risk appetite in that sense. Yeah.
Great. What is the source of the power source expansion projections? Is there a breakout for North America?
Can you say that again? The
power source expansion projections.
Oh, for North America. Oh, I don't have that in my head. And that would not, so to speak, fall within the kind of development finance that I'm speaking about here, which is the kind of ODA, which is development assistance based or government-based funding that then is generating larger flows in terms of loans
What would you say are the reasons for the lack of willingness by donors, in particular OECD, DAC donor governments, to make available concessional finance, such as de-risking instruments that are adjusted to the economic realities for green energy providers in low-income markets?
Yeah, that's exactly the question that I'm also contemplating. And having been in this business for 30 years, I have thought about it a lot and come to some conclusions. I think one is simply lack of understanding of what actually can be done in terms of de-risking, first loss, and so on, to crowd-in private funding, right? So I think we're still seeing a little bit of a detachment between the aid community, so the grant funding community, which is typically foreign ministries and aid agencies, and those government officials that have enough finance, background to understand how the commercial market actually works. There's certainly a much better situation today because you have people from the private sector working, for example, in Swedish SIDA, and there's quite a lot of them. But what seems to be happening at the same time is that these development finance institutions, so development banks, have tended to be influenced by the impact industry, perhaps, that have claimed that commercial finance, according to the terms I mentioned, is possible and can be successfully implemented in low-income environments. And that's just not proven to be true, right? And the currency risk, as I mentioned, is probably the biggest elephant in the room here, right? And so we've not at all yet achieved where we could and should be in terms of blended finance and true de-risking, and accepting that if you want to create a bankable environment in an environment that we would never consider bankable from our realities, you have to accept lower IRRs, for example, or some concessionality that may carry for a long time. But I mean, if you have a company doing a minor loss, that's not potentially a huge amount of money, perhaps, right, compared to what we're looking at. I mean, certainly not compared to if nothing happens.
Yeah, definitely. All right, let's have one more question and wrap up. What does the future hold for green energy development finance? What are the competing needs that donors focus on?
Well, I think, as I said, we need to really look at the missing middle space here. The large space is also underfinanced. Certainly, the DFIs are not big enough for it, and so. Maybe to start there, I think the DFIs, the international finance institutions, and the national development finance institutions, they need to find ways to free up their capital, right? And that's being discussed in the boards, and there's been a few headways that have been made there, issuing bonds based on the loan stock and other things, or as I mentioned, to syndicate the loan stock so that private individuals even or diaspora could go in and invest in these highly performing loans that have been sitting there for years. Right, rather than blocking the capital. But then also they need to be capitalized to a much higher extent than they are. And when these capital increases and fund replenishment happen, they look huge, right? I mean, they from a development budget perspective, they're the biggest thing out there. It does not mean they're big compared to the kind of money we spend in COVID, recovery, or in regional funds in the EU. It's tiny, tiny, tiny portions, right? I mentioned what the ODA looks like in terms of GNI, right? So we really need to move into a different sense of size here in terms of bridge these gaps. And the COP tried to, they talked about 1.6, I think, trillion, and they got 300 billion, right? It's just a right? For the missing middle, though, which is the main part of an economy, it's always been the main part of all economies in the world, except those that, have some big commodity like oil or something, right? It's the economy. There we need to be much more aggressive in making available de-risking finance to corporate and project finance actors in the green energy space, as I mentioned, right? You can't have well-performing companies in difficult market environments not finding any capitalization to continue to grow, right? That we just need to stop that, and we need to allow these development finance institutions that are financed by our tax money from the OECD countries, at least, right? They need to be able to do their work. You can't have board members that block it because they've heard from some impact fund that managed maybe through a short period of time to do market rate returns in hard currency, right?
Very interesting. Well, thank you very much, Magnus, for the presentation. A lot of interesting points, a lot of challenges to think about and resolve. So I'm glad that we are in that sector, and perhaps we do what we can to support renewable energy project developers. The recording of this will be circulated to those who registered and couldn't make it or joined late. And in the chat, you still can see and download Magnus's presentation and few useful links where you can submit your projects for review. Thanks again to everyone for attending, and thank you, Magnus. Have a great evening.
Thank you very much. Thank you all for attending.